How's it going, everyone? This is Brian Hoops here with Midwest Market Solutions. This is our latest internet video series. It is Friday, February the 12th, and we're getting set for a 3-day weekend here. And I had a crop report this week, had some information that came out in the report that we're going to share with you and talk about as we move forward. As you can see by the screen there is 7 offices around the country to serve you. We have an office in Missouri, Minnesota, North Dakota, 2 in Iowa, Nebraska, and South Dakota. So contact any of our offices for more information or marketing assistance. Set up a hedging trading account, as we would be glad to help you, market with you. And we're going to talk about this crop report and implications of what's happening in the marketplace, because I talk with a lot of producers every day. I hear a lot of different stories, and latest ones going around is there are a lot of people talking about the lows are in the grains or going higher. And let's see if that's true based off what the fundamentals say. Now, before we get started, let's talk about the risk of loss in trading futures and options. It's substantial. Each investor must consider whether this is a suitable investment. We can make no guarantee the advice we give will result in profitable trades, and everything that you hear here on our website is copyright of Midwest Market Solutions. All right, let's dive into this slide here that I have developed. It's very simple, and we're just going to take a little bit of time to go through some of this here. Now, what I've done is let's go first with corn, and we're going to look at July corn for a price comparison. What we're going to do is compare the stocks this year to last year and look at last year as a guide for what happened with prices. Now, we want to make sure you know that not every year is the same as a previous year. There's always different fundamentals, different factors, but we want to see what the fundamental situation is this year compared to last year, and see what happened over last year, because history can give us a guide at times of what may happen in the future. Now, on February 10th or 9th this week, USDA said ending stocks are 1.837 billion bushels for corn. So right here we have 2016 ending stocks, February stocks, 1.837 billion bushels. Compared to last year, we are up about 106 million from a year ago at 1.731. So we have an increase of stocks. That tells us how many bushels of corn, in this case, are on hand effective September the 1st at the end of this marketing year. And so that means our old crop stocks are a big amount, bigger than last year. In fact, these stocks are growing. Last year we started to see the shrinkage of stocks through the winter months because of decent demand. This year our demand trends are poor, and we see these stocks actually increasing from harvest. Now, where are we at on price? Right now we're at about 370 on July corn. Last year at this time, same date, we were at 399. So a year ago we had better pricing opportunities by 29 cents because of tighter stocks. So should make sense. What happened is prices moved lower through the spring. The job of this market here is to find a price level that's going to stimulate enough demand to shrink our stocks down. And we only do that by moving lower. In this case, we have to move lower to increase usage of our stocks. Better exports at lower prices. We need better feed demand. We need better ethanol production. Lower prices is normally the way to stimulate that. What the market did last year is went from a price of $3.99 to a low on June 15th of $3.47. So we roughly lost 52 cents from February to June before weather turned us and moved us higher. It was a weather issue, not a demand issue, that turned prices to the upside. So we lost 50 cents from February to June last year with this type of stocks. If we lose 50 cents this year, this actually puts our price at about $3.20 a bushel. I don't know if we're going to lose 50 cents this year. Maybe we'll have a weather issue in March and April during planting season that'll give us a rally or put a low in. But this is the pattern, this is the trend of the market. We have more bearish ending stocks for corn compared to last year. It's reasonable to think we're going to move lower, and maybe we'll move 50 cents lower from currently where we're at. I know a lot of people are talking lows are in, there isn't much downside risk. Last year, that same conversation resulted in 50-cent losses by the time we finally bottom the market. So let's keep that in mind here as we go forward. This is the reason that in our marketing program we've recommended to get 100% sold. Don't have anything on hand because of this fundamental situation. When the time comes to reown, we're going to step in with futures or options and do that reownership. I don't think the time is now yet. There's no weather issues. We'll start to make some recommendations as the marketing year goes on. Um, if you're storing, get crop in the bins, I would look at getting some downside protection, maybe some put options. And the worst case scenario is you have crop that you're paying storage at the commercial elevator for, and you've got downside risk. I think you need to either stop that or at least get some options in place to give you a minimum price level here going forward. Now let's look at the soybeans. So this is July soybeans. Our stocks, 450 million bushels this week. That's a big, big number. Compare it to a year ago, we had stocks of 191 million. So we're well over 2 times, almost 2.5 times what we were just 1 year ago. Our price as of today, 883. We're already much cheaper in price than the 991 that we saw a year ago at this time. Now we made a low in May, a little bit earlier than what the corn bottom, but so from February, March, April to May, we lost 71 cents in the soybean market. And that's with a fairly tight stocks number of 191 million. What happens this year? Is it reasonable to think we're going to lose another 70 cents? Well, if we do, that puts us down to about 812, 813 as a low on July soybeans. So again, not every year is the same, but this is looking at history. This gives us a possibility of where prices may gravitate towards as we go through February and into March and into April as this crop tries to ration these, or not tries to ration these stocks, but tries to stimulate demand. And if we get big South American crops to come in, it's certainly reasonable to see this moving into the low $8 mark, I think, as we get into the spring time frame. Now, hopefully we'll get some weather issues somewhere in the world that'll give us a price opportunity that'll allow us to do some marketing similar to what was seen in 2015. All right, let's thank you for your attention, your participation in today's meeting. Contact our offices in the future. You can reach me directly at the Springfield office, 417-501-5132, or go online to midwestmarketsolutions.com for more info. Have a great day, everybody. Good luck and good trading out there. And let us know if we can help you with your hedging. This has been Brian Hoops for Midwest Markets.